Okay, financialization in the USA. Adam Smith's theory of money. Adam Smith wrote in The Wealth of Nations how the banking sector worked in Scotland. People deposit gold and silver because it's safer, and in exchange for redeemable banknotes. Bank gave business credit, so it was a fractional banking because banks did not have as much as money in circulation. Banks lending money mean that money can exist multiple times, so money can expand. Also, if bank gave credit more than needed, they would lose profit. If credit is more than needed to do productive things, clients would withdraw gold and silver and use it elsewhere else. So banks would have less gold and silver to meet clients. If this happens, banks have to borrow from other banks at a high interest rate so that they don't go bankrupt. Adam Smith theory continued. Banks created growth in the economy because now businesses owners are not required to keep extra money from expansion or in case of emergency because they can borrow money from the bank. Banks cannot afford to take any risk, so they had to specialize in certain businesses to know if the company can pay back the loan plus interest. So the banks made sure that money is going into the right investment. How the financial sector works today. What is financialization? It's been used by academics for a number of decades now to discuss both the growth in size and power of the financial sector in our economy. So it's about 7% now of GDP. That's almost tripled in the last 40 years. So it's really grown in size, but it's also about the shift in business model. So if we look back in the 1970s, banks were mainly taking deposit, lending them out to businesses. Now, Alan Taylor and Mortis Skulik found that mortgages lending has surpassed non-mortgage lending. So that is a big shift in what the financial system does. Stock buybacks, cheap credit, and contributing to inequality. In fact, groups like the US Chamber of Commerce put out notes saying buybacks are really not all that bad. And this way in which the financialized system that we have funneled wealth up to the top of the enriched board, it basically dictates, unfortunately, a decision-making process that puts more money in investor pockets, but actually does not channel capital productively into places that are actually going to fuel underlying growth. For example, Apple has a huge sum of cash that doesn't use to avoid tax. What they do is get loans at a very competitive rate and do buybacks to increase the value of the stock, which makes huge shareholders money. Example of lobbying power. Why are derivatives not on the exchange market? A study by Brett Hines, a security analyst, where he said that the profit margin in derivative would be reduced by 20% if you moved everything into exchange. What he essentially didn't say is that is translate into about 7 billion a year. The bill did not pass because the financial lobby threw a tremendous amount of money and effort at rolling back the provisions that they didn't like. And you can see it in the infamous example of Jamie Dimon actually getting involved in the 2014 budget bill and saying that the banking sector didn't like the certain loophole for derivative and wanted it changed. Conclusion: the financial system is not working to create jobs and create real growth and productivity. However, it's becoming a machine that makes the rich richer through fast and productive speculative type of assets, and it's all being protected and not sufficiently regulated because of the huge lobbying power. Thank you.